Hey there, and welcome back to your San Diego County Real Estate Report from the Real Estate Jedi. In this and every report video, we give you the latest numbers and charts on the San Diego County real estate market. We take a look at interest rates, which directly impact affordability, and we touch on the latest news, stories, and topics that complement your repertoire in keeping you informed on the state of the housing market. And if you're not already a subscriber, be sure to hit the subscribe button and click the little bell to get notified of videos when they come out. Without further delay, let's go ahead and jump in and start looking at our housing inventory for San Diego County.
All right, so looking at January 2020, you can see we had a 33% decrease year over year from inventory in 2019. Almost on par with where we were at the end of, or at the beginning of January 2018, but still nonetheless, we had this kind of pause and increase in inventory as interest rates ticked up. But you can see we're pretty much headed down to all-time lows once again. This is going to be the lowest January inventory level on record that we have access to here, and just goes to show you how much of an inventory problem we're seeing more and more as we continue in this environment. New listings down 19.6% year over year, so far fewer listings coming on the market. Pending sales are up 12.6% year over year, and sold listings are up 14.7%. So far fewer active listings to pick from, fewer newer listings coming on the market, more properties going under contract and pending sales. This all, of course, drives the price up. We are at 8.7% increase year over year. And this is subject to change as some of the data gets adjusted here, but essentially 8% up year over year from where we were last time. You know, we're still definitely seeing this upward pressure on these prices, so long as I think these interest rates are going to stay in the same environment, possibly even go lower. Let's take a quick look at active market time. 7.3% down year over year. Again, this is typically something seasonal. You can see it spikes up right around the holidays, but and it comes down to lows around the hottest time of the year, usually mid-year. But 7.3% decrease in active market time. Properties are going fast. Most of the properties we've been selling just in the last month and a half have had multiple offers. It's a hot market out there, guys. And I think that as long as we continue to see interest rates where they are, like I said, that's going to probably continue unless, barring some other influence on the market. Let's take a look at interest rates real quick. 30-year fixed rate mortgage as per Fred. This is across the United States, 30-year fully amortized. So you can see on February 13th, we were at 3.47 on a 30-year fixed rate. Go back a year, February 14th, 2019, 4.37. So almost 100 basis points lower than we were 1 year prior. And you can see that's, of course, a major stimulus, I should say, to the housing market. So not saying it's a justified one necessarily. We saw what happened as soon as interest rates went up before. But this is certainly, without a doubt, something that is playing a major factor in the reason the market remains so hot. Inventory levels and demand is like, of course, that's the elephant in the room. That's obvious. That's the issue, but when you really consider how much of an impact interest rates have, and again, we saw that as soon as interest rates started going up last year, we saw a major pullback in the marketplace. Everything slowed down. Many sellers got scared. There were flipping companies that were worried about the inventory that they were carrying, and all of a sudden people got out of their euphoria state of mind and realized that, just a small change can make a big difference.
So check this out. If we plug in the numbers on a financial calculator for a loan of $500,000 at 4.5% interest rate, you can see that our payment is roughly $25.33 per month for principal and interest. And if we contrast that with the same loan amount at a 3.5% interest rate, we can see the payment drops nearly $300 per month. So if we were to plug in the same payment that we were paying at 4.5% on a $500,000 loan, but keep the payment amount at $25.33 every month, you can see that we would actually be able to get a loan and service that loan with that payment for $564,000. That's a 13% increase just because of that 1% difference in rate. So you can see why these low interest rates are so positively affecting the market, and why, as long as they stay low, or maybe possibly even go lower, there still could be a very significant upside strictly due to these rates and the prices in San Diego.
So taking a look at jobs report, January jobs were up 225,000 jobs, higher than the 158,000 estimated gain that they were expecting. And average hourly earnings rose 3.1% year over year as well. So the economy, all the signs point to us looking like we are in one of the healthiest economies we've ever been in. By many estimates, the healthiest economy in decades. Unemployment is still at nearly all-time lows, nearly across the board. Wages are going up, employment's going up, interest rates are low, of course, and that's helping everything. So the question is, if we are in one of the best economies that we can expect, but we need to keep these interest rates low to sustain that, what other potential fragile areas do we have of the economy and in the real estate market?
Also, a topic I've been paying more attention to in recent weeks is the growing deficit of unfunded liabilities, and pensions in particular. And a great interview with Robert Kiyosaki, author of Rich Dad, Poor Dad, a great book. If you haven't already read it, you're behind. You need to go read it. I watched this interview with him the other day that was very thought-provoking, and I'm linking the video in the description of this video below, okay? The reason this topic is so important is that when you look at the ever-increasing deficits and the people getting left behind, and then the numbers and the projections for where these deficits will be in a few years, the numbers are staggering. I mean, people that relied on the government and corporations and unions to protect them and pay them a pension in old age and retirement are being completely left behind. In fact, they're actually essentially being robbed. So if you look at the numbers for like Social Security and Medicare and the projected deficits in the coming years, and you go to something like usdebtclock.org, you're going to have to ask yourself, where is this money going to come from? Right now, we are in the boom. We are in, one of the supposedly best economic times we've seen in many, many years, by some accounts, many decades. And if we're not addressing these problems now, when are we going to address them? And also, very important to consider too, this isn't just in the US. This is happening in major countries across the world. So anyway, I'm not going to go into too many details here, but when you have some time, the interview is definitely worth the watch. Definitely thought-provoking, and is not a bad thing to keep in the back of your head as a filter when making decisions otherwise. So that will do it for us in this report today, folks. Thanks for watching. And again, if you haven't already, be sure to subscribe and hit the like button, and I will see you in the next video.